Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for December 5th, 2022. It's hard to believe it's already December and 2022 is almost over, but that doesn't mean volatility is going away. This market has been extremely volatile, and the perfect place you want to be is with Forex Analytics in the Forex Analytics community. So if you haven't tried that out, it's only $1 for 10 days. Try it out, and then make sure you download the mobile app too. Download the mobile app so you can be involved in our community. This is what our community kind of looks like. It's extremely busy. Always talking about charts, always talking about World Cup, always talking about macroeconomics. We have news and research rooms and Spanish chat rooms, all sorts of things. So make sure you come check us out. All right, let's get into the markets. And I want to talk a little bit about how we're going to have to do some drawing this week based on what had happened last week. And one of the things about technical analysis just in general is, I draw things and I try to imagine what I think is going to happen in the market. And I'm definitely not always correct, not at all by any stretch of the means. But when my imagination goes awry and then I realize that the reality is that the market doesn't do what I thought it was going to do, I have to redraw the charts, and we're going to have to do a little bit of that today. So you'll see the charts that we posted last week on last week's week ahead video, and we'll do some drawing from there. And if you all want analysis with Forex Analytics, just go into the basic technical analysis, the harmonic, the Elliott wave analysis. If you want some more advanced analysis on where you think or where our team thinks the market's going, make sure you do that. All right, so let's go into the charts and let's talk about, well, we had a jobs report on Friday, and the jobs report came in better than expected. Initially, the dollar strengthened, but then we saw the dollar weaken towards the end of the day against a lot of different currencies. Now, the euro, as you can see, we closed near its highs of the session. This is a big deal, in my opinion, because we're making a bull flag pattern, or at least trying to make a bull flag pattern that still has some distance to go. So if you look at the bull flag pattern and think about where it could go, we could make it all the way up to eventually 107.40. Now, what we should do from here, let's go ahead and remove this this previous fib level, because this is showing us our extensions. Let's go from the very high back over here to the low, and let me undo the magnet really quick. As soon as I get that on, undo the magnet. I'm gonna put on my retracements. You'll see that we're nearing the 38% retracement that comes in around 106.20. Now, a lot of you might be wondering why the dollar actually weakened, but keep in mind the dollar weakened after the strong jobs data against other currencies more so than others, or against some currencies more so than others. It weakened against, like the euro closed on its highs. The sterling, closed near its highs of the session. But if you notice, like the Aussie and the Kiwi, they were struggling a little bit. Well, the Kiwi wasn't, but the Aussie was, right? And the dollar yen, obviously struggling as well. So, a lot of this has to do with where you're playing the dollar. You don't necessarily need to be in a one size fits all shoes? No, one size fits all feet. You know what I'm saying. With the dollar, you got to be a little bit more specific, especially if we get into a risk off type of environment, then things are going to change dramatically. But right now, the market's bounced back. The dollar sold off. The stock market, like I said, bounced back a little bit because I think most people anticipate that the jobs data is going to eventually weaken going into the first quarter. So that is the running assumption with the majority of the market. So if you see the euro, the euro still has some upside, but does that mean that the dollar is going to continue to weaken, going into this next week? This next week's a big week. We're a week of trading ahead of the following week. We're going to have the FOMC, and so we're in that quiet period. So the Fed governors, regional Fed governors, and the Fed chair is not speaking. They're staying away from the press. So we're going to be watching obviously what the rest of the market is thinking. But after this big of a move lower in the dollar, I wouldn't be surprised if we see some consolidation going into this week. Now, with the euro, 106.20, that seems really doable at some point this week, whether it's right off the get-go or whatnot. If you look at the sterling is challenging some pretty key resistance on a horizontal basis. So, or did I say the sterling? Yeah, I did say the sterling. So the sterling's squeezing quite a bit, but could we continue to extend those gains towards the 128 level? I know it's hard to believe, especially as close to parity as we got just a few weeks ago, but the market is in squeeze mode and we're closing well above the 200-day moving average. So if the sterling can actually get a foothold above 123, there's a risk that we continue higher. But this is a lot of it will rely on the dollar itself. And if you look at the dollar yen has dropped precipitously. And I would venture to guess that we're very close to an AB equals CD completion, an equal leg move. And let's see how close we are, even though we're below the 200-day moving average. You can see how we're about ready to complete. Well, you could argue that we did complete near that 88% retracement. So, being that the dollar is sold off so aggressively against so many different currencies, there is a risk that we start to see, maybe a bounce or a consolidation, at least ahead of the FOMC that is next week. Now, there is other data that's coming out this week, and we're going to talk about that, especially like in Australia. You got the rate decision. You have a rate decision in Canada as well. And speaking of Canada and the dollar Canadian, let's take a look at that pair, because this is one of those where we have to redraw a little bit. We had this head and shoulder pattern, a really nice setup, really good breakdown, and then the dollar stopped in its tracks and started rallying against the Canadian, which is interesting because the dollar has been so weak against other currencies like the euro and the Kiwi and whatnot. So the dollar Canadian is a little tricky. That's scary if you are a bear. And then heading into the Bank of Canada, this week, you got to be thinking about that as well, especially if you're trading on the short side of the dollar CAD. So the way I'm going to redraw this right now is I'm going to delete the head and shoulder pattern. And I am going to draw out the long-term triangle pattern that, if you're in the Forex analytics community, you already know what I'm going to draw here. But we're going to be dealing with more of a long-term triangle consolidation and let me get rid of this previous channel. We don't need that anymore. And, I think the dollar Canadian is at risk right now. I know we're making... is at risk. Let me complete my sentence. Is at risk of a possible breakout, because notice how we're making higher lows and each dip is being bought in the dollar Canadian. So what I'm going to be looking for, especially this week, especially keeping in mind that the Bank of Canada is coming up on Wednesday. Remember, they're one of the first central banks that really started to move. And if they start to show some dovishness, and they've already kind of been going there, but if they show some continued dovishness, and if we see some crude oil, weaken as well, which crude looks a little vulnerable, we start breaking above this 136.50, and we might challenge 138, 140. There is a risk now that is building if you are on the short side of the dollar Canadian, or if you're looking for longs. We start getting above 135.50, definitely 136.50, then, the bull, narrative is going to take place in the dollar CAD. Keeping in mind that Bank of Canada is at 10 a.m. Wednesday Eastern time, the BOC rate decision. A couple other things with currencies, and then I'm going to shift gears and look at the bond market, and then I'm going to look at precious metals, and obviously I want to look at the S&P and the markets, the other markets as well. One other thing I want to focus on this week is the dollar Mexican peso. The dollar Mexican peso, they have inflation. Mexican inflation data is on Thursday. By the way, on Friday we have our PPI in the U.S., which is going to be very, very scrutinized, obviously, ahead of the FOMC this next week. But with the dollar Mexican peso, one of the things most of you all know, I've been really a pretty persistent Mexican peso bear, Mexican peso bull, dollar Mexican peso bear all of this year. And it's really, drifted lower most of the year. even with stocks so strong. But the problem that we have on the on the dollar mex is the dollar mex actually came to a pretty I would say it's pretty important support, because this is the big breakout point. You can see post lockdowns during COVID. So when we had those COVID lockdowns back in early 2020, the dollar Mexican peso took off, and we just basically got back all of those gains, and you could say close some gaps. There were probably some price gaps around there those days as well. The thing about the dollar Mexican peso is overall, I do believe it is moving lower. I think overall, you're going to see the Mexican peso start to strengthen. But the risk right now is that 19 holds, and we do see a bounce back maybe to 20. We're pretty far away from the 200-day moving average. And if you think about that, just the, maybe some sort of revision to the mean, getting back towards, these breakdown points, or where the 200-day moving average will eventually slide back down, below 20. That wouldn't surprise me in this current environment, and especially that we have stocks pretty strong. Now, I'm going to talk about the stock market. I'm going to talk about bonds. I'm going to talk about gold. But before I do that, I need to mention our sponsor, and that is the Trader Funding Program. So if you haven't checked out the Trader Funding Program, make sure you check it out. This is the way that you can access larger amounts of money without risking your own money. Okay. You do have to take an assessment, and if you pass the assessment, you can then access our capital, and you keep 75% of the 75% of the returns, and you take none of the risk. Now you have to make 10% return in an unlimited amount of time and not lose more than 5% on a trailing basis, and you have unlimited time to do that. You can't lose more than 4% in one day. Then we figure your risk management skills probably aren't so good, so those are the prerequisites. But if you want to learn about the Trader Funding Program, click on this video right here. 2-minute video might change your life. We authorize payments to live accounts to people that are trading our capital every week now, and we've been doing it every week probably for the last couple months, now that we've had this going for the last 6 months. So the Trader Funding Program is great, and it's a great way for you guys to do some proprietary trading, especially if you just don't have access to larger account values, right? So check it out. All right, I'm going to get back to the markets here. Let's get back over to I want to talk a little bit about, let's talk about precious metals. So gold closed really strong, and this is another example of what we might have to do to redraw things. So I was looking for a possible head and shoulder pattern in gold. Is it still possible? Absolutely it is. Matter of fact, if you look at this trend line that we drew previously, what if that neckline is actually just above the 200-day moving average and it's horizontal? How about if we still have some work to do? We have some work to do before we eventually break out to the upside. I think it's entirely possible. I think you got to be careful with gold right around the 1800 level, especially if the dollar starts to gain strength from here. If the dollar index really starts to bounce from channel support and it starts to move higher from here, that would mean that gold potentially would pull back before it rallies. So I want you to keep an eye on gold near the 1800 level. You know what gold's really watching though? Gold is watching the bond market. And I know you might be looking at the 10-year and you might be thinking, wow, but look at the 10-year, Blake. The 10-year is breaking out. Yields are really slumping. But is it the entire bond market? Take a look at the longer end of the curve and take a look at the 30-year. The 30-year is now pressing up against previous support, right? Which should be acting as current resistance. And you can see how price is already starting to pull back a little bit as we are there. And if the 30-year holds and we see a little bit of a pullback here in bonds, that would mean a rally in yields, which would also mean probably lower gold and also a higher dollar. That's something that you should be thinking about as we move into next week, especially ahead of the FOMC. It's not like I'm looking at the bond market thinking, oh man, yields are heading down and we're gonna trade into new lows in the bond market and yields are going to scream to new highs. They could, but I do think this is going to be a consolidation before we get that last Fed meeting in at the middle of next week. All right, one last thing I want to cover with you. And by the way, if you guys and gals are appreciating these week ahead videos, make sure when you're watching us on YouTube, give us a thumbs up. It doesn't cost anything to do that. And it doesn't cost anything to actually subscribe to the channel so you don't miss any of these week ahead videos or all of the interviews that Dale Pinkert does on the F.A.C.E show that's free each and every day. Speaking of free, if you guys don't listen to Ryan and K-Man and Stelios on the Flow show, or you don't listen to the free F.A.C.E show every single day, where not only myself but the rest of the team gives our analysis and gives you an update on what they believe or they think the market is doing that day, check it out. It is free. You can find the links in the description of this video. Okay, back over to the S&P. Let's go take a look at the S&P really quick. And as you all know, we talked about it last week about the S&P getting back to channel resistance. Well, guess what? That 4,100 level looks to be pretty important. And obviously the 200-day moving average, considering that we bounced off of it on Friday, this whole area is going to be very critical for bulls and bears. You know, I did this poll on Twitter, and you can see the poll right here. I did this poll on Twitter last week. Is the S&P going to close above or below 4,000 by year end? The reason why this is so important, I remember there's one person, you know, she was like, oh, this is useless. I'm like, well, you're blocked. I don't need you in my stream, and you don't have the pleasure of following me. It's not useless because what it is it's measuring sentiment. You know, I've been on Twitter now for 12, 13, 15 years, whatever, you know, I don't know how long it's been. I've never bought any followers. I've never done anything like that. Actually, I don't even know how many followers I have right now. I could go look, but I don't even know off the top of my head. But I know that a lot of retail traders follow what I do, and they have for years. So when I take a poll like this, it's a pretty large sampling of the retail environment. And, you know, retail is obviously very mixed at the moment as far as where they believe the market's going to go. That's interesting when you see information like this, because when you start looking at the markets and you know you're at such a critical juncture, it is truly a hard call. It's truly, to me, it's more of a 50-50 coin flip. We could talk about the economy, but you also have to realize the stock market is not the economy, right? And you have to also realize that we're going into year end, and there are asset managers that are chasing returns, you know, because if they don't, they're going to get redemptions next year, and they're going to be managing a whole lot less money than they're in 2023 than they are managing in 2022. So you have to take all these things into account when we're heading into year end. Plus, we have the big FOMC meeting. So what I think is anywhere between, you know, you can see the 78% retracement around the 4160 level, and probably down here at 3,900, somewhere around here. This is all, and let me delete this really quick, and let me just make it a nice little square. This is really a tricky area. And I think, you know, if we start getting above that 78% retracement, sure, could we trade up to, you know, the 4,300 level, 4,400? Yeah, I would think that's entirely possible going into year end. And if we trade below 3,900, could we be trading back at 3750? Sure, I think that's entirely possible too, because I can make an argument for either. And when you can make an argument for either, and you see sentiment numbers that are so, you know, wishy-washy, and you know we're at critical technical levels, those are just a bunch of critical pieces of information that should be telling you, make sure you're careful, make sure you're managing your risk, and make sure you're sized up appropriately so you don't get smashed if the market goes against you. And always keep your stops in place. All right, guys and gals, my name is Blake Morrow. I hope you enjoyed this week ahead video. And if you have, make sure you give me a thumbs up. I'd appreciate it. And I hope you have a great remainder of your weekend. I'll catch you tomorrow morning on the F.A.C.E show, which is free. I'll see you there. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.